Today, we're really getting into something that affects all of us, but maybe we don't always dissect it this way. Money. And specifically, the human side of it, the messy bits.
Right, the psychology behind it all.
Exactly. We're looking at some source material today that kind of pushes back on the old idea that, being good with money is all about complex math or being super smart.
Mm-hmm.
The main idea we're exploring is actually pretty simple, but really important. How well you do financially often has less to do with how intelligent you are.
Right.
And way more to do with how you behave, your habits, your mindset.
It flips the script a bit, doesn't it?
It really does. So our mission here is to pull out the key stories, the insights from this material, and make them relevant for you, the listener. Help understand why we all think about money so differently, and maybe get some useful perspective.
Yeah, trying to make sense of it all.
We'll touch on some really interesting contracts, like this high-powered executive who ended up broke versus a janitor who became a millionaire. How does that even happen?
That comparison is a great starting point, actually. The source uses it to really hammer home the main point.
Okay, so tell us about the executive first.
Yeah, so there's this story, maybe a bit anecdotal, but illustrative, of a tech executive in a fancy hotel restaurant. Apparently, he accidentally shatters a lamp.
Oh.
The manager comes over, tells him it's, say, $500 to replace. And this executive, showing this incredible arrogance, pulls out this thick wad of cash, peels off like $5,000.
Wow, 10 times the amount.
Yeah, throws it at the manager and basically says, "There's $5,000, now get out of my face, don't insult me." Something like that.
That's quite a statement, not just about the money, but the attitude.
Exactly. It screams ego, right? A total disregard for the value of money, prioritizing showing off over, well, anything sensible. And the source points out that kind of behavior isn't sustainable.
And did it catch up with him?
Apparently so. The story goes that years later, he ended up filing for bankruptcy. Went broke.
Okay, so a cautionary tale about behavior right there.
Yeah.
Now, the janitor, that sounds like the polar opposite.
Completely. Ronald Reed, he worked as a janitor, a gas station attendant, lived in rural Vermont, like just a regular guy, seemingly.
Not exactly the profile you'd expect for someone leaving, what was it, millions to charity?
$8 million, yeah. It shocked pretty much everyone who knew him.
How'd he do it?
Just simple, consistent behavior. Lived incredibly frugally his whole life, saved diligently, invested those savings quietly, mostly in reliable blue-chip stocks.
No flash, no big risks.
None at all, just patience and discipline, compounding over decades and decades. When he died, this huge fortune was revealed.
So the executive, high income, probably smart, but terrible behavior, ends up with nothing. The janitor, modest income, simple behavior, ends up a philanthropist.
That's the core contrast. It hammers home that financial success is driven more by these soft skills, patience, emotional control, discipline, than by pure intellect or fancy financial knowledge.
A genius can mess it up financially.
Totally. And someone perfectly ordinary, intelligence-wise, can build serious wealth with the right habits. It's not something they really teach you in finance class.
That makes a lot of sense when you put it like that. But it's about behavior. Why does money feel so complicated and honestly stressful for so many people? It feels like it should follow rules, like physics. But it doesn't.
That's a really good point. We want it to be like physics, predictable, right? Input A gets you output B. But the source argues it's much, much closer to psychology.
How so?
Because it's tangled up with emotions, personal biases, and everyone's unique background. It's deeply subjective.
So my experience shapes how I see it, and your experience shapes how you see it.
Massively. Think about it. What seems like a crazy financial decision to you might make perfect sense to someone else based purely on what they've lived through.
Can you give some examples?
Sure. Imagine growing up in extreme poverty versus growing up with wealthy parents, or experiencing hyperinflation where money loses value overnight versus living through decades of stable prices.
Or the Great Depression versus the dot-com boom.
Exactly, or even different national experiences. Post-war Germany or Japan versus the US in the same period, or Australia's long economic boom versus, say, the US experience of 2008. All these things fundamentally shape your intuition about risk, saving, debt, everything.
Wow. So my little slice of history
Might be, like the source says, statistically insignificant, maybe 0.0000001% of world history.
Right.
but it probably shapes 80% of how you think money actually works. It becomes your mental model.
And that explains why smart people disagree so fiercely about financial stuff?
Absolutely. They're not necessarily disagreeing about the data. They're disagreeing because their personal experiences have taught them fundamentally different lessons about how the world operates.
You mentioned a study.
Yeah, the NBER study.
Yeah.
National Bureau of Economic Research. They found people's willingness to take investment risks was strongly tied to the stock market returns they experienced in their late teens and early 20s.
More than their education or intelligence.
More than their education, intelligence, or even their current income level. It's that formative experience that sticks. Bill Gross, the bond king, even acknowledged his own success rode this massive wave of falling interest rates for decades, a completely different reality than his father's generation knew about bonds.
That really puts things in perspective. It also helps understand decisions that look, well, irrational from the outside, like the lottery ticket example.
Right. Low-income households sometimes spend a noticeable amount on lottery tickets, even if they don't have, say, $400 for an emergency. Mathematically, it looks nuts.
Yeah, the odds are terrible.
Terrible odds, absolutely.
Yeah.
But the source pushes back with this idea. No one is crazy. You have to try and understand the reasonable story from their perspective.
Oh, okay. So what's the reasonable story there?
If you're living paycheck to paycheck, saving feels impossible. Any small amount you put aside gets wiped out by the next unexpected bill. Your prospects for significantly increasing your income might feel really limited.
So saving $10 a week feels pointless.
It can feel utterly pointless, yeah. In that context, the lottery ticket, even with its astronomical odds, represents the only tangible path, the only hope they feel they have, to access the kind of financial freedom and lifestyle they see others enjoying.
They're buying hope, not expected value.
Exactly. They're paying a few bucks for a dream, for the possibility, however remote, of escaping a reality that feels inescapable otherwise. It's perfectly reasonable to them within their lived experience, even if it's mathematically irrational.
That changes how you look at it.
Yeah.
It's about empathy, understanding their world.
Right. And that need for understanding context also applies when we look at success and failure, which brings us to luck and risk.
The uncontrollable factors.
The huge uncontrollable factors. They're like siblings, the source says, always present, but really hard to pin down or accept, especially when judging outcomes.
You mentioned Bill Gates earlier and his less fortunate partner.
Kent Evans, yeah. They were collaborators, both brilliant, both driven, starting out together. Gates went on to build Microsoft. Evans tragically died in a mountaineering accident before they even got that far. That's pure risk, right? Nothing to do with skill or effort. Just bad luck with devastating consequences.
It's easy to forget those what-ifs.
We do. We look at someone super successful like Gates, and we tend to attribute it all to genius and decisions. When we face setbacks ourselves, we might lean towards blaming bad luck or external factors.
Hard to be objective.
Very. Think about Cornelius Vanderbilt back in the day, building his railroad and shipping empire. He famously said stuff like, "What do I care about the law? Hey, and I got the power." He deliberately broke rules, took massive risks.
Bold moves.
Bold, yes. But the line between bold and reckless is incredibly thin, isn't it? He succeeded, so we call it bold. If he'd failed, we'd call it reckless. Luck plays a huge role in which side of that line you end up on. Even someone like Benjamin Graham, the icon of safe investing, had a huge chunk of his personal success come from one massive bet on Jigoku stock, a concentrated bet that kind of break his own diversification rules. Luck was definitely a factor there, too.
So Bill Gates' quote, "Success is a lousy teacher."
Makes perfect sense. It can blind you to the role luck played, make you overconfident, but failure can be a lousy teacher too. It might make you overly timid if you made a good decision that just got hit by bad luck, by risk.
So what's the takeaway?
A key one is, nothing is as good or as bad as it seems. The outcome alone doesn't tell you everything about the quality of the decision. You need to build resilience into your financial life. Survival is key. You need to be able to withstand the bad luck, the bad decisions, so you can stay in the game long enough for the good decisions and maybe some good luck to pay off.
Staying in the game. That sounds like it connects to knowing when you have enough, not constantly chasing more.
Absolutely. That relentless pursuit of more is a major danger zone highlighted in the material. There's that great story Kurt Vonnegut told about being at a party hosted by a billionaire with Joseph Heller, the author of Catch-22.
Oh yeah, I think I know this one.
Vonnegut points out to Heller, "You see that guy, our host? He probably made more money yesterday than Catch-22 has made in its entire history."
And Heller's response.
Perfect. Heller says, "Yes, but I have something he will never have." Vonnegut asks, "What?" Heller says, "Enough."
Wow. That hits hard. Just knowing your limit.
It's about defining your own finish line, because the problem with just chasing more is that the goalpost keeps moving. Social comparison is brutal. There's always someone richer. It's a battle you literally cannot win.
And it can lead to terrible decisions.
Definitely. Look at Rajat Gupta. Rose from poverty, became CEO of McKinsey, worth maybe $100 million. An incredible success story.
Certainly enough, right?
You'd think. But apparently he wanted to be a billionaire. He got involved in insider trading related to Warren Buffett investing in Goldman Sachs during the financial crisis. He made maybe $1 million illicitly from the tip.
$1 million. When you already had $100 million.
Exactly. It's peanuts, relatively speaking. But he risked everything, his reputation, his legacy, his freedom for that marginal, unneeded gain. He ended up going to prison.
That's tragic.
It is. Or think about the guys at Long-Term Capital Management, the hedge fund that blew up in the 90s. Nobel laureates on board, incredibly smart people, already multimillionaires.
Right, LTCM. Huge leverage.
Massive leverage. They were risking money they absolutely had and needed their reputations, their partners' capital, to try and make even more money they absolutely didn't need. As Warren Buffett said about them later, that's just foolish. Defining enough is maybe the most crucial step, because the alternative, that insatiable appetite, is where the really big regrets happen.
So having enough isn't just about a dollar figure. It's about recognizing when striving for more starts jeopardizing things that are actually more important.
That's it, exactly. It's about understanding what money is really for. And maybe its greatest potential isn't just buying more stuff.
Okay, so what is its greatest potential, according to this view?
Control. Control over your own time. The source points to research, like Angus Campbell's work, showing that having a strong sense of controlling your life, feeling like you're the one calling the shots in your day-to-day existence, is a way more powerful predictor of happiness than your income level or the size of your house.
More important than being rich.
Seems so. The highest dividend money pays isn't the yield or the capital gain. It's the ability to wake up and say, I can do what I want today. It buys autonomy, independence.
The author had a personal story about this, right? Investment banking.
Yeah, he talks about chasing an investment banking internship solely for the money. Got it. High projected salary. But realized within weeks that it came with insane hours, no control over his schedule, being constantly on call. He was miserable.
So he quit.
Quit after just a month, yeah. Gave up the potentially huge paycheck. Later, he saved up about $12,000 from waiting tables. And he realized that 12 grand, while not a fortune, was enough to cover his basic living expenses for a good while, allowing him to try being a writer or musician, whatever he wanted then. That relatively small amount of money, because it bought him freedom and control over his time, felt infinitely more valuable than the giant salary that came with golden handcuffs.
That's a really different way to measure wealth.
It is. And it might explain why, even though average wealth in the U.S. has skyrocketed since, say, the 1950s, reported happiness levels haven't really budged much.
We got richer but not happier.
Maybe because we traded time and control for bigger houses and more stuff. Especially now with knowledge work, where the work follows you home. Your brain is the factory, and the factory is always open, right? We might have less control over their downtime than previous generations, despite being wealthier.
So the goal isn't just pile up money, but use it to buy back your time and autonomy.
That seems to be the argument. And it also means that trying to use wealth to buy admiration is often a losing game, too.
How so? Like the fancy car thing.
Exactly, the Ferrari paradox, as the source calls it. When you see someone driving a really expensive, flashy car like a Ferrari, what do you instinctively think?
Wow, cool car. Or maybe, I wish I had that car.
Right. You're rarely thinking, wow, the driver of that car must be an amazing, admirable person. You're thinking about the car and imagining yourself in it and how you might feel or be perceived if you owned it. The admiration is aimed at the possession, not the possessor.
Huh. I never thought of it that way, but yeah, that's probably true.
And it connects to another point. True wealth, the kind that builds independence, is often invisible. It's the money you didn't spend on the Ferrari. It's the investments quietly compounding. It's the paid-off house.
You can't see saving.
You can't see savings. Ronald Read, the janitor millionaire, his wealth was totally invisible until he died. That makes it incredibly hard to learn from genuinely wealthy people, because their most important financial habit, consistently not spending money they could have spent, is hidden from view. We only see the spending.
Which brings us back to the importance of saving, not just earning.
Absolutely crucial. The source really emphasizes this. Building wealth depends far less on your income or your investment genius and far more on your savings rate. Wealth is just the accumulated gap between what you earn and what you spend over time. You need a decent savings rate. A high income with high spending gets you nowhere. A modest income with a high savings rate can make you wealthy over time. It's about keeping your lifestyle expectations in check relative to your income.
It all seems to loop back to behavior and psychology, and that difference between being purely rational versus being reasonable.
Yes, that's such a key distinction the material makes. A decision might look suboptimal on a spreadsheet, not perfectly rational from a pure finance theory perspective.
Right.
But it can be entirely reasonable for a real human being living in the real world with emotions, biases, and personal goals.
Like the example of Harry Markowitz, the Nobel Prize winner.
Exactly. The guy who literally invented modern portfolio theory, the mathematical framework for optimal diversification. When it came to his own retirement money, what did he do? He didn't build some hyper-complex, optimized to the decimal point portfolio.
What did he do?
He just split it 50-50, half in stocks, half in bonds. Simple as that.
Why? That doesn't sound optimal.
Because his stated goal wasn't maximizing risk-adjusted return, it was minimizing future regret. He knew seeing his portfolio swing wildly would make him uncomfortable, potentially causing him to make bad decisions later. The simple 50-50 split helped him sleep at night.
Minimizing regret. That's not usually in the finance textbooks.
No, but it's deeply human. It was reasonable for him. Investing isn't done in a vacuum. It involves your spouse, your anxieties, your future plans. A strategy that looks rational on paper, like leveraging up massively after a crash, might be completely unreasonable emotionally for almost anyone. You'd bail at the worst time.
So doing something slightly suboptimal that you can actually stick with
Is far, far better than a perfect plan you abandon when things get scary. Maybe you invest a bit in something you're passionate about, even if it's not perfectly diversified. Maybe you hold more cash than advisors recommend because it gives you peace of mind. Maybe you avoid certain investments that just feel wrong to you. If these unreasonable choices help you stay the course with your main strategy and sleep well, they might be the most reasonable things you can do.
It allows for personal preference, for your own psychology.
Yes, your well-being matters. Sticking to the plan matters more than squeezing out the last theoretical basis point of return.
Okay, so we trust our reasonable instincts sometimes. But what about learning from the past? We often look to history to figure out what to do next financially.
And history is incredibly valuable, for sure. It gives us context, shows us patterns of human behavior, how markets can behave in cycles. But the source strongly cautions against using history as a perfect predictor of the future.
Why not? Don't patterns repeat?
Some broad patterns might, related to fear and greed, but the specifics change constantly. The financial world today is radically different than it was 50 years ago, or even 20 years ago.
How so?
Think about retirement savings. The whole system of 401ks, IRAs, that structure is relatively new in the grand scheme of things. Venture capital as a major asset class is relatively new. The speed of information, globalization, algorithmic trading, these things change the dynamics.
So past performance isn't indicative of future results, basically.
Not just for a specific stock, but for the whole environment. Even Ben Graham, Mr. Value Investing himself, kept tweaking his formulas throughout his career because he recognized the market landscape was evolving. Relying too heavily on what worked in 1950 or 1980 might make you miss something fundamentally new or different about today.
And the future is full of surprises anyway.
Exactly. It's dominated by those tail events we talked about, the big, unexpected shocks like 9/11 or a global pandemic or a major technological breakthrough. Things that models based on past data simply cannot predict. As Daniel Kahneman said, the correct lesson to learn from surprises is that the world is surprising.
That uncertainty, that potential for negative surprises, probably feeds into pessimism, right? So you mentioned pessimism seems really common in finance.
It does, doesn't it? Doom and gloom gets a lot of attention. It often sounds smarter, more sophisticated to be pessimistic. Pointing out flaws is easier than building a case for optimism.
But is it the right bet?
Over the long haul, the source argues, probably not. While setbacks are guaranteed and often dramatic, the overall trajectory of human progress, driven by billions of people trying to make things better, tends to be upward. True optimism isn't naive. It's recognizing that problems get solved, innovation happens, and things generally improve, even if it's messy and slow. Being a serious possibilist, as someone put it.
Why is pessimism so much stickier then? especially financial pessimism.
Several reasons, maybe. One, money affects everyone, so bad financial news feels universally threatening. Two, progress is often slow, incremental, almost invisible day to day. Think about the decline in fatal diseases over decades. It's huge, but gradual.
Right, you don't notice it happening.
But setbacks, a market crash, a big company going bust, a war starting, those are sudden, dramatic, headline-grabbing. Destruction is fast. Growth is slow.
That makes sense.
Also, we're wired for stories. Narratives shape our understanding much more powerfully than statistics, especially when things are uncertain or complex. Think about medical history before germ theory stories and beliefs ruled. Or Bernie Madoff people bought the story of steady returns, ignoring the mathematical impossibility. We tend to look for evidence that confirms our existing beliefs, our preferred stories, and we often overestimate our own control, attributing success to skill and failure to bad luck.
It's a minefield of biases.
It really is.
Okay, this has been fascinating, unpacking all these psychological layers. If we try to boil it down, what are the most critical, actionable things listeners should take away from this whole discussion?
All right, let's try to synthesize. Based on the source material, the big ones seem to be: first, focus on your behavior, more than smarts. Discipline, patience, managing your ego.
Okay, behavior over brains.
Second, respect luck and risk. Be humble when things go well, forgiving when they don't. Focus on what you can control. Third, build wealth primarily through your savings rate. Wealth is what you don't see, the money not spent. Keep that gap between income and ego.
Save more than you think you need to.
Fourth, expect things to go wrong sometimes. Individual investments will fail. Plan for it. Focus on your overall long-term plan.
Don't panic over bumps.
Fifth, the ultimate goal is using money to gain control over your time. That's its highest value. Independence.
Time, not just stuff.
Sixth, seek respect through kindness, humility, empathy, not flashy spending. Remember the Ferrari paradox.
Right.
Seventh, save just for saving's sake. Build that buffer for the unexpected curveballs life will throw at you.
Room for error.
Which leads to the next point. Worship room for error. It's essential for survival, and survival is essential for compounding. Don't plan for everything going perfectly.
Plan for imperfection.
Ninth, avoid financial extremes, taking on too much debt or concentrating too much in one thing. Keep flexibility because your goals will change.
Stay adaptable.
10th, be reasonable, not just purely rational. Make decisions that work for you, that let you sleep at night, even if they aren't 100% mathematically optimal.
Know thyself.
11th, use history as a guide, not a map. Learn its lessons, but expect the future to be different. Be ready for surprises.
History rhymes. Doesn't repeat exactly.
12th, figure out your game, what you're trying to achieve in your time frame, and stick to it. Don't get distracted by what others are doing or chasing hot trends.
Play your own game.
And maybe lastly, maintain that balance. Short-term paranoia, enough to ensure you survive the bumps, combined with long-term optimism, enough to believe in future progress and stay invested.
That's a fantastic summary. And those personal examples from the author really help illustrate the reasonable part.
Yeah, like deliberately keeping their lifestyle flat, even as income rose, to boost savings. That's a conscious choice against the tide of lifestyle inflation.
Getting the goalpost to stop moving, as he put it.
Right. Or paying off the mortgage early. Mathematically, with low rates, maybe keeping the mortgage and investing the difference looks better. But the psychological benefit, the feeling of security from owning the house outright, was more valuable to him. That's reasonable.
It's not just about the numbers.
And holding more cash than usual, it drags down returns in good times, sure. But it provides that oxygen of independence, ensuring you're never forced to sell stocks at the worst possible moment because you need money unexpectedly. It's buying resilience.
These really show it's about tailoring things to your own peace of mind, your own definition of security, not just following a generic formula.
Precisely. At the end of the day, doing well with money seems less about complex financial engineering and more about understanding human nature, especially your own. Managing your behavior, your expectations, your fears.
This has definitely given me, and hopefully our listeners, a really fresh way to think about our relationship with money. Less finance, more human studies.
Well put. And maybe a final thought to leave everyone with, drawing from the material. We know the world changes. We know our own goals will evolve. We know unexpected events, good and bad, are basically guaranteed to happen.
Yeah.
So the question becomes, knowing all that, how much actual room for error are you building into your financial life right now? How much buffer, how much flexibility do you have to make sure you can survive the inevitable surprises and stay in the game no matter what happens?